This is the Economic Club of Florida, a distinguished platform for discussion of the major national issues of the day. On today's program, Lamar Taylor, Chief Investment Officer for the Florida State Board of Administration, on the high price of U.S. equities and the relationship between foreign capital into the U.S. and our trade deficits with other countries.
If the view is that we should think about recalibrating global trade, particularly with our trade deficits, keep in mind there may be a countervailing impact, which is capital flow outside of the United States.
Good day and welcome to the 591st in our series of distinguished speaker programs. I'm Harvey Bennett for the Economic Club of Florida. We all know Florida has grown into a big state beyond its geographic footprint. It's third largest by population in the U.S., has the fourth largest economy in the country with $1.7 trillion of gross state product as of 2024. And if it were its own nation, Florida would have the world's 15th largest economy. So it's no surprise that Florida also boasts the fifth largest public pension fund in the U.S., and our speaker today knows all about that. He is Lamar Taylor, Chief Investment Officer for the Florida State Board of Administration, the SBA. The SBA manages about $275 billion in assets, including those of the Florida Retirement System and others, including the Florida Hurricane Catastrophe Fund. Lamar, welcome.
Thank you. I'm very happy to be here.
Before we get into what you're planning to share with the Economic Club of Florida today and the implications for personal investors in our audience, let's talk a little bit about you. You're a local boy, as they say. You grew up next door in rural Gadsden County, Florida. Tell us about that.
I guess I'm one of those that didn't move very far away from where I grew up, and I've had the wonderful fortune of being able to actually make a very good living and career where I grew up, with lots of family ties and lots of proximity to some really good folks. One of the things I guess I would say about growing up in rural Gadsden County, Florida, is I had the opportunity early on to learn the value and dignity of hard work. I took a lot of fairly difficult summer jobs, working in plant nurseries and so on. And you meet a lot of people that do that day in and day out. I did it during the summers. They did it day in and day out. It's hard work, and those are tough folks, and you really learn the value and dignity of hard work, which I think has helped me sort of moving forward in a career, understanding that really the best way to sort of get ahead is just simply roll up your sleeves and do some hard work. And I think that served me well over the years. You probably learned as well some basic laws of human nature growing up in the outdoors. Absolutely. Yeah, or fishing, hunting? More fishing than hunting. I never really had the patience for hunting, but did my best at fishing and still enjoy doing that from time to time. Oh, it's terrific. Now, you've also had a big impact on the local economy here, especially the music scene. Mm-hmm. You're one of the original organizers of Tallahassee's annual Ward of South Music and Literature Festival, which is now in its 11th year. How did you come to do that? Well, first of all, thank you. I think it's a very generous representation of my participation. I have been incredibly fortunate, again, to work with some really great people throughout my career, one of whom is Mark Mustian. And Mark is the original founder and organizer of that festival, and it's a music and literature festival. And of course, everyone knows Mark is a very well accomplished author and committed to the arts. And so, just by virtue of him indicating this is something he wanted to do, I just asked how I could be involved and volunteer. And so it's myself and a host of other people that have come together across the community to put that together. And it has been I think it's been very successful. I think it's a very unique and interesting festival that we do year after year. And I think kudos to Mark and Sarah Mercer and others who've really put a lot of effort in putting that together. It's a fantastic festival. Well, and in recent years, you've had the pleasure of
holding it in Cascade Park, which is a gorgeous venue.
Absolutely. It's designed to be an outdoor festival. It's designed to be almost entirely free. There's upsides and downsides. When you're doing that in the spring, it's great weather, but then you're also sort of at the mercy of the elements. And so from time to time, there's a big scramble to sort of figure out where the alternative venues are. But I think they've kind of got that down pretty much to a science now. So they've done an excellent job at being able to sort of manage environmental risk, I guess.
Well, you have to, living in Florida. Now, you had a different career path than probably most investment managers, let alone the chief investment officer for the state of Florida, managing about $275 billion with a B in assets as of today. Tell us a little bit about your career path.
Yeah, so way back when you're kind of young, trying to figure out what you're going to do to be able to make a good living, and I had some early on advice. Look, the thing you need to do is be a tax lawyer. And I didn't know anything, so I was like, all right, well, what do you do? Well, you have to be an accountant, and then you got to go to law school. And so that's what I did. I went through, got an accounting degree and a CPA, and then went back to law school, and then got a master's of tax law and worked for Ausley & McMullins, a well-known law firm here in Tallahassee. A lot of people may know Doobie Ausley. It's been my fortune to know Doobie Ausley. And so I had the good fortune of working with that firm for a while. But over time, just realizing that, I think the practice of accounting and law was really not sort of my cup of tea. And then I had the opportunity to sort of essentially move in-house with the State Board of Administration here, working for Ben Watkins, who was the director of bond finance. And I did a lot of tax legal work with the issuance of state bonds and so on. And again, another great benefit of mine being able to work with Ben Watkins for a number of years, and then had the opportunity to move into the State Board of Administration proper, the pension plan, working for and with Ash Williams. Again, another huge influence on my personal and professional career. And so I've just been able to sort of do that all along. Really keeping an open mind to taking on new challenges and not trying to sort of pigeonhole myself into a specialty, which ironically early on in my career, that was what I was dead set to do. I wanted to be a specialist. I wanted to specialize in a narrow area of tax law, and I refer to this from time to time, but it stuck with me. At some point along in my career, I came across, I think, a New Yorker cartoon, and it was this panhandler out on the street, and underlined the caption was, look, I spent years thinking I was carving myself a niche, and I found I was digging myself a hole, and so that always stuck with me, and it was this idea of just kind of, hey, keep an open mind and be a generalist and think about how you can add value to the organization you're with, however that might be. You don't have a narrow sense of responsibility. And as a result, I've been able to do a lot of different things at the State Board of Administration. I was Deputy General Counsel. I was the Chief Operating and Financial Officer for a while. I was Deputy Executive Director. I was ultimately the Interim Executive Director and Chief Investment Officer for a bit, and now I'm the Chief Investment Officer. And so I came at this particular role, I would say, from the bottom up. A lot of my peers, I would say, come at it from the top down. If you're building a house, I think a lot of my peers came at it from the architect side, where you're looking at math and how do you kind of everything sort of works together. And as a transaction lawyer and an accountant, I came at it from the bottom up. I sort of came at it as like you were a plumber or something. You just sort of come at it and you sort of see the pipes of the underlying financial system. And so that's been very, very helpful and instrumental to me as I've been able to kind of think about how to take on this new role as a Chief Investment Officer.
Now, your predecessor at the Florida State Board of Administration that you mentioned, Ash Williams, who's a longtime member and former board member or existing board member of the Economic Club, Ash Williams wrote about you, quote, "Lamar Taylor is a case of still waters running deep. He's a keen observer and analyst, adept at perceiving nuances and interrelationships that others might miss," unquote. Pretty accurate?
Again, I think that's a very generous assessment, and maybe it's an instance of where I've been able to kind of fool people for a long time. I think maybe if I were to sort of have to sort of give an assessment, again, early on in my law school career, I had a tort professor who said, look, when the plow is dull, work harder. And I think I've just sort of taken that to heart. At some point, again, it just comes down to rolling up your sleeves and constantly thinking about how do you work harder to add value. So if that translates into something like still waters run deep, I think that's a fantastic, generous assessment, and I'm happy to take it.
Tell us just a bit about what you're going to be talking with the Economic Club of Florida about in just a few minutes during your formal presentation.
So, I've had the great fortune of now being the Chief Investment Officer of what I think is the best public investment management organization in the country. And so I'm going to talk a little bit about what we do, and primarily what we do for our largest investment mandate, which is the Florida Retirement System Defined Benefit Pension Plan. And not only what we do, but how we do it, which is primarily around asset allocation. And I'm going to talk about asset allocation. I'm going to talk about the assumptions that underlying our current asset allocation. I'm going to talk about whether or not those assumptions are still valid in the current economic cycle that we're in. And then I'm going to talk a little bit about, whether we might be seeing some changing things in the current economic and financial landscape that might cause us to reconsider some of those assumptions underlying our asset allocation. So that's pretty much what I'm going to talk to today.
Looking forward to it. Lamar Taylor, Chief Investment Officer for the Florida State Board of Administration. A pleasure. And thank you. We're looking forward to hearing your upcoming presentation on how the SBA is viewing a changing world.
Thank you. Looking forward to it.
Now, here's Club Board member Dominic M. Calabro, President and CEO of Florida Tax Watch, with our formal introduction.
My name is Dominic Calabro. I'm a former chairman, more importantly, a member of the board of directors, and honored to be a trustee. This is a great, great club. A couple of other people that were not mentioned, I want to mention Violet Brown and her wonderful assistant, young intern, Milan, as well as Mark Rodberg's daughter, Missy Rodberg. Brandy, we're really glad to have you. She's former budget director, served with my dear friend, Chris Spencer, who I will say in front of all of you, I've said to him many times, but one of the best budget directors I've had the chance to serve with some 45 years. So let's give it a public service. Thank you, Chris. I had to embarrass you. I just had to embarrass you, that's all. But Lamar, we're really glad to have Lamar here. Lamar Taylor is the Chief Investment Officer of the State Board of Administration of Florida. As a state constitutionally created investment management organization, providing $275 billion of investment and trust services to various Florida governmental entities. Since joining the board in 2002, he served in key roles throughout the organization, including Deputy General Counsel, Deputy Executive Director, Chief Operating and Chief Financial Officer, and also as Interim Executive Director and Chief Investment Officer from 2021 to 2024. Lamar is an attorney and a certified public accountant with private and public sector experience. We're very proud to have Lamar. Lamar? Oh, there you go. Good, buddy.
Well, good afternoon. First of all, thank you, Dominic, for that introduction, and thank the Economics Club for inviting me to speak. It's a very special honor for me, not only because of the role this organization plays in the community and the state, but because so many members of this organization, many of whom are sitting here today, have been so instrumental in my career over the years. And so you all know who you are, and I want to thank you, because without your guidance and wisdom and support, I probably wouldn't be standing here today. And I specifically want to thank one individual on this panel, my current boss, the Executive Director of the State Board of Administration, without whose support I can tell you I would not be standing here today. So thank you for that. So you've heard a little bit about who I am. I want to take a minute or two and tell you a little bit about who the State Board of Administration is and what we do, for those of you who may not know exactly what we do. So that's really on this slide here. The State Board of Administration is a constitutionally created state investment organization. We are headed by the governor, the state's chief financial officer, and the state's attorney general. And we have the responsibility for investing some of the largest and most important mandates in the state. We have about 200, and that chart says 260 as of March. So currently it's about $270 billion of assets under management. And these are the four largest mandates. We have about 25 mandates. These are the four largest. Starting with the largest on the far left is the Florida Retirement System Defined Benefit Pension Plan. We invest the assets of the pension plan. We also invest and administer the assets of the Florida Retirement System Defined Contribution Plan, about $20 billion. We administer a $30+ billion 2a7-like money market fund for local governments called Florida Prime, and we administer and invest funds for the Florida Hurricane Catastrophe Fund, which is a state-created reinsurance-like program that supports Florida's homeowner population. Like any well-run organization, we have probably paid too much money to a consultant somewhere to come up with a fancy mission statement. This is our mission statement here. There's a lot of words on the page, and I'm way too old to remember all of them, so I like to try to shrink it down to something that I can wrap my head around, which is our mission at the State Board of Administration is to provide financial security. And when it comes to our largest mandate, the pensioners, the beneficiaries of the Florida Retirement System pension and investment plan, our job, our mission is to ensure that they feel secure about their financial future. And how do we do that? It's primarily by delivering excellent investment performance, and that's what this chart here shows. It's a 25-year history of our net of fees absolute performance, so going back to 1999, which is on the far left of the chart, all the way to the most recent annual performance, June 30, 2024. I'm happy to say that over a 25-year period, we've only had 5 years where we've had drawdowns. 4 of those drawdowns occurred during 2 of the most significant equity market drawdowns since the Great Depression, so in 2008 and 2009, during the global financial crisis, and again, prior to that was 2000, which was the bursting of the dot-com bubble at the turn of the century, and most recently in 2022, we had a downturn when we had a spike in inflation and corresponding rise in interest rates, which repriced all cash flows, and fixed income was not a diversifier to global equity over that period of time. I unfortunately neglected to have a chart of our relative performance against benchmark, which if I had included would also be equally impressive. Over a 10-year period of time against our benchmark, we generated about 50 to 75 basis points of above benchmark return, so alpha, so to speak. That's about 1/2 to 3/4 of 1%, but on an annual basis, that's about $1 billion to $1.5 billion a year. So over a 10-year period, about $10 to $15 billion of additional performance over benchmark. This slide is sort of a slide on relative performance, but it's relative performance against our peers. This is the SBA's performance in the light green bar against what's called the TUX Top 10. So TUX stands for Trust Universe Comparison Survey. It's a survey of Wilshire Consulting, a big consulting firm. These are the top 10 plans in that universe. They're large defined benefit plans. Aggregate assets under management about $2 trillion. The median plan is about $170 to $200 billion, so roughly our size. And we do pretty well relative to those to our peers. I can tell you it's a very competitive group. So just doing a few basis points more over a 5 and 10-year period puts us pretty high in the stack. So that's a little bit about who we are and what we do. And what I want to do is spend the rest of the time that I have to talk about how we do it. And in order to do that, that really gets me, I have to talk about sort of the biggest tool in our toolkit, which is asset allocation. I'm going to tell you a little bit about what it is and how we do it. I'm going to talk about the assumptions that underlie our current asset allocation and whether those assumptions are still holding in the current market environment. And then I'm going to talk towards the end about maybe some things that might be changing that might give us reason to revisit our asset allocation. So when we talk about asset allocation, what is it? This is it. This is our current asset allocation. We are the pie chart on the left as of today, as of market values. The pie chart on the right is the asset allocation of the median pension plan in the TUX universe, so it gives you a little bit of a comparison. They look pretty similar. And for those that have a hard time reading the chart, so starting with our pie chart on the left, that blue-green area that comprises most of the pie, that's global equity. So that's publicly traded U.S. and non-U.S. equity securities, comprises about 47% of the asset allocation today. And if you move clockwise along that pie chart, the next pie slice is fixed income, core fixed income, things like U.S. treasuries, mortgage-backed securities, high-quality corporate credit, commercial paper, and so on. It's about 21 or so percent of the allocation. Next is real estate, and 2/3 of that 9 or almost 10% of allocation real estate is in actual direct bricks and mortar buildings, so office buildings, multifamily units, industrial developments, retail space, specialty properties, actually bricks and mortar buildings, about 10% of the allocation, and then the rest is something we call alternatives, and that's broken up into private equity, which you may have heard something about, like if you've ever heard of Blackstone or KKR or Carlyle. We've had some of those speakers come in. So it's just basically ownership interests in private companies that haven't been publicly traded, and we typically own those through investment partnerships. We have an allocation to something called active credit. That's a new allocation, and that's going to be things like private credit, which are loans to these private entities that don't trade on the public exchanges. It also includes sort of higher returning fixed income assets like high net worth or high yield and emerging market securities. And then finally, we have an asset class called strategic investments, and it's sort of our diversifying bucket. So it carries things like hedge funds and infrastructure funds, opportunistic investments, and so on. And if you look at that compared to our peer universe, it looks very similar. I would say if you really sort of squinted hard at that, what you would see is that our peers have about 5% more of their portfolios in what they call alternative investments, and we have about 5% of our portfolio in things like public equity, fixed income, and real estate. So that's what asset allocation is. Asset allocation is an outcome. It is a byproduct, but it's also a process. And for us, the process of asset allocation is something we do about every 3 to 5 years. And essentially what it does is it involves us taking stock of our investment opportunity set, looking out across the horizon of all the things that we could invest in. And then we kind of take that and we bucket those up into asset classes. And we work with our consultants and our internal teams, and we kind of try to assess what we would expect to be forward-looking rates of return and volatilities and correlations for all of those opportunities. We run that through mathematical models, and it spits out what's called an efficient frontier. And so an efficient frontier for us is basically a line, and on that line is basically almost all of the various permutations and combinations of asset mixes. And any point on that line represents a point such that there is no higher rate of return or lower degree of volatility for a particular asset mix. That's what makes it efficient. You're getting the most return for the risk you're taking for that asset mix. And that line typically slopes up and to the right. So at the bottom left are asset mixes that typically have the lowest return and lowest risk, and at the top of that line are asset classes that typically have the highest return and highest risk. And embedded within that point is that you generally get compensated for taking investment risk. That's sort of a fundamental tenet of investment markets. You get compensated to take risk. That's called a risk premium. And I'm going to come back to that concept in a minute. But once we have that line, we basically pick a point on it where we believe we're going to get an appropriate rate of return at an acceptable level of risk. Now, there's a lot more that goes into just picking that point. It's not, we don't throw a dart. There's more to it that goes into. That's another hour conversation about exactly how we pick that point. But at the end of the day, ultimately, what we're doing is we're picking a point on that line that we believe is an appropriate return and an acceptable level of risk. That becomes our asset allocation, and that's what it is today. But it's not static. The asset allocation changes over time, and this is a chart that shows that. So this is a chart that shows what our asset allocation was in 2023 and what it is today. It doesn't look all that much different. We don't take drastic changes when we make these changes, but we do revisit this from time to time. And so if you take a look and you look at sort of where things changed, what you would see is we moved about 8% of the portfolio into fixed income-like exposures. And so we moved a little bit more from core fixed income there on the sort of blue, 16.5% to 21.5%, and then created an asset class called active credit. And again, that active credit is sort of fixed income exposures, private credit, high yield, emerging market, but fixed income exposures generally, and we took those exposures from the riskier side, the riskier parts of the pie, which would be hedge funds, the strategic investment portfolio, and global equities. And so the question is, well, why did we do that? What was it in this process that suggested that we should do this back in 2023? And the answer is, and it's in the very top left slide there, what we saw was a shrinking risk premium at the time. In other words, that we were going to get less compensated for taking risk in 2023. That was our forward-looking expectations back then. And largely that was because at the time we believed, and I think we were proven right, that you would see interest rates increase. And so that equity risk premium we expected to shrink from the bottom up. And so you would get higher fixed income returns and as a result, less compensation for taking risk. And essentially, the reason why we felt that way is it would be a mean reversion with respect to long-term interest rates, and that's what the other charts represent as kind of this notion of mean reversion. If you were to sort of draw a line before and after the financial crisis, you can really sort of see this break point in terms of mean levels of interest rates. Before the financial crisis, you had a much higher sort of baseline level of interest rates, and then after the financial crisis, you had a much lower level of interest rates. And our view was that the financial crisis era was not a normal era, and that at some point you would see a normalization of these interest rates, not just nominal rates, but real rates, that is, rates above inflation. And so sort of why that was at the time is sort of in these charts. These are some of the materials that we had sort of backing our asset allocation there. And basically our view was that COVID, frankly, accelerated some of the things that you were already seeing in global markets. It was just provided an accelerant to it. And those are things that we expected to generate higher base rates of inflation going forward. So deglobalization, for example, this higher degree of geopolitical conflict. And then what you saw in COVID was, frankly, exposing the weaknesses and the fragility of long supply chains, and particularly supply chains with people who may at some point be our adversaries. And so as a result, there's been more of an effort to reshore and nearshore some of those supply chains. That's expensive. It requires people to spend money. The labor market's tightening due to shrinking populations and so on, so that's also expensive. You have fewer people available for jobs. You're going to have to pay more to get labor. Energy transition, at some point was a theme. There's a lot of expense around that. It's very capital intensive and yet to be, sort of still playing out. And definitely more of an increase in federal spending. So an aging population, the bulk of the federal budget is to Social Security, Medicare, Medicaid. And as the population continues to age, there's going to be more spending there. There was also a lot of spending around infrastructure. So in the last few years of the previous administration, there was a number of bills around infrastructure. So a lot more federal spending just really competes for capital in the capital markets. If the government's issuing debt and it's a very safe security, it's going to have to compete against other capital that's out there. It generally pushes rates higher. And so our view was that as you would see sort of this sort of base level of inflation, you would see higher real fixed income levels, because historically you had seen a Fed funds rate above inflation. You had historically seen a 10-year above inflation. You had historically seen 10-year rates above Fed funds rates. That's called a term premium. And we expected that we would start to see that again. And if we would see that at levels that would be nominally a 4 to 6% rate of return for fairly much less riskier assets, we have a targeted rate of return of 6.7% for our pension plan. If we can get the bulk of that return through fixed income assets, well, that's what we wanted to do. And so that was the assumptions that underlied our asset allocation changes in 2023. And the question is, well, what do we think about that now? So that's been 2 years hence. How is that working? What do we think? Well, I think we're still on the same track. We continue to see a very narrow risk premium. That is that our expectations, how much we're going to get paid to take risk, continues to be relatively narrow. But this time it's not so much because of rising rates. We think that rates are fairly normal. We might see a steepening of the yield curve, but rates are fairly where they, pretty much where they are. Right now, it's just more that equities are frankly expensive. And that's kind of what this chart here shows, and it's not the best chart in the world, and I apologize for it. There's the chart on the upper left, the dark piece there is just frankly a snapshot of the current yield curves, just sort of establishing the point that one of the assumptions that we made has been validated, that yields would normalize. When we were doing our asset allocation in 2023, we had a fairly steeply inverted yield curve, so short-term rates were much higher than 10 years. Now that's sort of normalized. You actually have a sort of an upward sloping yield curve for most of it. So that's been validated. But we haven't seen risk premium come back, in part because equities remain very expensive. And I wish I had all the time to sort of really delve into the details of the charts at the bottom of the page. They're excellent charts. They're put together by a member of our staff. They tell a really great story. It's a lot of detail. And so I'll just sort of summarize by saying the dark blue dot on each of those charts, the lower that dark blue dot is, the more expensive equities are. Essentially what it's doing is it's plotting the expected 10-year rate of return given current equity levels today. And so if that dot is lower in that graph, it means equities are relatively expensive. And in two of those charts, equities are about as expensive as they've ever been. So that's kind of the state of the world that we live in today. This is a better view of that. That shows you sort of how expensive equity. This is a chart of the S&P 500. It's not really normalized. It's always, these things always look impressive because as you go back far enough, there's not some sort of constant dollar deflation to it. If you were to put it on a log scale, it wouldn't look quite so impressive. But what's the point of that? This looks really impressive. So it looks like equities have just continued to run, which they have. And if you look at price earnings multiples today on forward-looking earnings, 21 times forward-looking earnings today, that's where they were in January of 22, before you saw a lot of this sort of interest rate increases from the Federal Reserve. And so then you did see a bunch of interest rate increases. Cost of capital went up, and now equities are just as expensive as they were before all of that run up in the rates. So equities are expensive, and particularly U.S. equities are expensive. And that's kind of what this chart shows, is that even if you tried to be a global investor and invest in a global index like the MSCI IMI, it's an index it's a capitalization weighted index. And so you would think, well, I'm being diversified. The problem is it's a capitalization-weighted index, and so as these U.S. companies become more and more valuable, your weighting to the U.S. in that index increases as well, and that's what this is showing today. So in 2007, the weighting of the United States, U.S. companies in this global index was about 40%. Today it's 64%. And so even if you were trying to be a global investor, well, I'm diversified. Well, the capitalization has kind of been working against you in terms of the value of these companies. You could have done a little bit more proactive approach and tried to rebalance into these foreign markets. But if you'd have done that, you'd have been very, very disappointed. As you see, they've just continued to kind of, decline. Okay, well, all right, equities are expensive. So what? What do you do about it? Well, in order to kind of answer that question, you need to kind of figure out why equities are expensive. What's driving them? What do you want to do about it? So in my opinion, U.S. equities are primarily expensive because of concentration. So there's concentration really in three areas. Everybody's heard about the concentration in the Magnificent Seven, and that's what this chart shows. This chart shows the impact of the Magnificent Seven as constituent of the S&P 500. I'm going to next slide. I'm going to talk about that concentration today is really about concentration in the future of AI and the spending that's going on regarding artificial intelligence. In addition to those areas of concentration, you've actually got quite a bit of concentration in the spending of very wealthy individuals in the United States. I'm going to have a chart on that as well. But right now you can see the impact of this concentration. So the graph on the left, you've got three lines. The blue line is the performance of the 493 companies that are not the Magnificent Seven. The green line is the performance of the Magnificent Seven. And then the black line is the performance of the S&P 500, which is sort of the average of it. And you can see how much the performance of the S&P 500 is really driven by the Mag 7. In fact, for 23 and 24, the returns of the Mag 7 were, in 23, it's almost 10 times the return of the other 493 companies. And that's a function of earnings. So they have just had fantastic earnings, and that's what the chart on the upper right shows. Not only have they had really good earnings, they've had really good earnings surprises. And if you go back and you look at earnings surprises over the last several years, in the last 10 quarters, for the most part, they've all been positive surprises. So up. So if you're going to surprise, you want to surprise on the upside. And so that also adds fuel to the fire in terms of the ownership of it. Something that's also a part of this, which I'm not going to get into, is sort of the prevalence of and the growth of passive investing. So there's just now a lot more people who want to just, rightfully so, is a very efficient way of doing it, just sort of get their exposure by just investing passively. And so there's less discretion around these weightings and sort of this active view. So that's also been another fuel to it. But as I said, concentration in the Magnificent Seven ultimately is concentration in the future of artificial intelligence because there's been so much capital expenditures driven by the Magnificent Seven in this space. And that's what this chart shows here. By the way, a big shout out to J.P. Morgan. As you can tell, I've borrowed quite a number of their slides. They actually do a fantastic analysis, and if you've never heard or listened to Michael Simlis, you should. A ton of really good material there. But this is from their materials, and you can see the bar graph on the left is really kind of the growth in capital expenditures around artificial intelligence. and I think this is in billions of dollars, and the most recent read in 2024 was, I think, about $200 billion, which was almost $100 billion up from the previous year, and it's expected to go up to $278 billion. And that's, you can see again the line graph just to the right of that is kind of, when you look at total capital expenditures, you can see that really expenditures on everything else is kind of slightly down. Expenditures on intellectual property, i.e. Artificial intelligence, is really ramping up there. The interesting thing is this $200 to $250 billion. If you look at growth in U.S. GDP over the last so many years, last year I think it was about $680 billion was the growth in dollar terms of U.S. GDP, which means that this $200 billion expenditure is somewhere between a quarter to a third of the growth in U.S. GDP is attributable to capital expenditures in AI. And I make that point because there's a history of these things not ending particularly well. Whether it's you look back at the railroads, a number of people spending making a lot of capital expenditures to try to capitalize on being the first that captures demand, but there's going to be so many winners, and so but everybody's spending, and they have to in order to preserve their status. You saw that in 2016 in the shale oil boom that ultimately didn't end well. So there's a lot of spending going on. I have no idea how. Maybe AI is different. Who knows? I don't know. These are huge companies. They can afford it. They have fantastic earnings. So it's not pretending anything particularly ominous, other than to say there's a lot of spending going on. It's a big portion of U.S. GDP growth, and that's one of the areas of concentration with the Magnificent Seven. The other area of concentration in terms of U.S. equities is the reliance on spending by wealthy consumers. And this was a chart that I pulled actually from a Wall Street Journal article, which I thought was very insightful, that 50% of U.S. spending is now attributable to the top 10% of income earners. And according to the article, that's a change. That it used to be in the 30s, 35% range, and now it's 50%. The interesting point about that is, going the wrong way. The chart on the far right is sort of the makeup of U.S. GDP. So $25 trillion of U.S. GDP, 70% of that is spending. And so now fully a third of U.S. GDP, not growth in GDP, but fully a third of U.S. GDP is attributable to the top 10% of income earners in the country. And I make that point only to say that these are people who are also those who who may be spending on a pretty healthy wealth effect. This is a chart off the distribution of financial accounts of the Federal Reserve, and what it shows is the top 20% of incomes own almost 90% of corporate equity securities. And so that scales in a kind of an interesting way. So the top 1% own almost 40% of U.S. equity securities. And so it kind of goes down. So when you think about kind of maybe who might be most inclined to stop spending, it's probably the bottom part of that 20%, the 10%, those who are doing pretty well. But if they see the market turn, they may not be as liberal with their spending, and it sort of creates this sort of vicious cycle kind of approach. So that, in a nutshell, is kind of the point about sort of where we are today and sort of how we look at where the world is. How this translates into our decision on asset allocation. To be blunt, I don't necessarily. It's interesting. It's not something, in my opinion, I think needs to sort of foment for changing our asset allocation. Frankly, this was something we kind of saw in 2023, is that we would have a shrinking equity risk premium. We saw interest rates adjust. We haven't yet seen equity risk premia adjust, but they might. If they do, because we have already implemented the asset allocation change, moving a good portion of our, starting in 2024, we moved about $12 billion out of public equity into fixed income. If we were to see a resurgence in equity risk premium, it would mean that equity prices have dropped. We would have the ability to reallocate back into that space. That's kind of the point. You have the ability to sort of rebalance your portfolio as opportunities come up. Now, in the meantime, it also means that because we're 47% allocated to equities, our market value is going to adjust as those equity valuations adjust, but we will have the ability to sort of rebalance into a good environment. Now, at the margin, we may undertake some views around this. It may create opportunities for a little bit more active management. We typically are not big active managers in U.S. large cap stocks, simply because from our research, after fees, you hadn't typically gotten paid to do that. But this is an interesting time. So maybe there's some thoughts around that. Maybe there's some thoughts around outside the United States. If I go back to that other chart, when you look at multiples for the MSCI World ex-US, they're at about 16 times, whereas the current multiples on historical earnings are about 24 times. So cheaper outside the United States. But at the end of the day, those are just marginal changes. I don't feel like that there's anything that needs to necessarily be drastically done to our current asset allocation, so I feel pretty confident about it. But the interesting thing to me is maybe kind of the things that we're seeing, not just in the financial markets, but geopolitically and across a number of different fronts that actually might cause us to reconsider some of the assumptions we made in 23 with respect to the underlying asset allocation. And one of the things that we didn't really challenge a couple of years ago, which was the notion that the United States would still be the destination for capital globally. That had been the case, it has been the case for the last 40 years. But a number of things have kind of caused me to maybe reconsider that. There's a fairly influential paper written by Stephen Mirren, who is the chair of the President's Council of Economic Advisors, and he was with a fairly prominent hedge fund before that. I think it's something like a user's guide to recalibrating global trade or something or another, but it's fairly interesting. And of course now he's the chairman of the Council of Economic Advisors. It's a fairly interesting take on the burden of the U.S. dollar as the reserve currency and trade deficits. And so, as you would expect, that sent me down a rabbit hole around national income accounting. And you'll see the relevance of this here soon. So I'm going to explain this chart. So national income accounting. I didn't know much about this until I started reading all of this. But we've heard a lot of talk about trade deficits, right? Everybody's aware that we've had a trade deficit for decades. What wasn't quite so apparent to me is that there's a concept called identity of payments, or a balance of payments, and therefore an identity of payments between trade deficits and capital surpluses for a country. And if you think about it from a closed economy, it kind of makes some sense. Like if I'm manufacturing widgets and selling them so I can buy and you produce food, and that's really kind of all that there is. I got to sell my widgets to buy your food. If I'm buying more food than I'm selling widgets, I got to make up the difference by borrowing. It's a closed system. And we don't really think of it that way, but because we are buying more than we're selling in the goods market, by definition, you got to be importing capital to be able to do that. Now, it doesn't mean that trade deficits and it doesn't mean that trade deficits cause capital surpluses. It could be the capital surpluses cause trade deficits because you've got so much capital inflowing into your capital markets, and the value of your currency goes up so much that it makes goods produced elsewhere much cheaper. And so you just buy them because they're cheaper than your current. But there is an identity to this. And so what this chart shows here, this is from BCA Research, and so the bottom dark line there is the trade deficit. I believe that's in billions. In any event, it's the trade deficit. These are flows. The green line is inflows, cross-border financial inflows. And I'm focusing on flows because that's very specific. So it's an apples-to-apples comparison. You're seeing flows in terms of capital markets from other countries. So that's a net obligation to the U.S. Consumer or citizen. And then outflows in terms of goods. The deficit being sort of stammering around on the ins and outs, but anyway, it's a trade deficit, so purchasing goods with money coming into the United States. Essentially what that's showing is a flow perspective. This is a chart I created, which I think it's not exactly apples to apples, but I like it because of the visual. So instead of flows, what this shows on the top is stock. That is the net international investment position. That is the cumulative effect of years and years and years of net foreign capital inflows to U.S. capital markets. And so it's on a reverse scale. So the higher that top line is, the more negative that number is. The greater the greater the inflow of foreign money, the greater the debt essentially to foreign security holders. The bottom line is the trade deficit. But that's a flow. That's not a stock. That's just the actual trade deficit. But you can see a pretty stark sort of alignment there. The thing is that this and not only, I mean, there's additional facts that sort of this is a chart from Apollo that talks about the tracking over time foreign holdings of U.S. Certain U.S. treasuries sort of moving up. This is a chart also from Apollo showing foreign ownership of U.S. equity markets. And so this is sort of, again, sort of reinforcing the notion that these trade deficits, one way or another, are also associated with capital inflows and capital surpluses. The interesting thing is that, and this is another chart again, sort of the chart in the upper right corner showing sort of contemporaneously what that's doing to the values of U.S. securities. So the green line there is the percentage of U.S. equities in global capital markets. The dotted black line is a percentage of treasuries in U.S. capital markets. And again, you're just seeing those values go up. The chart below that is the 10-year rate, so tracking over time. All of that inflow of capital creates demand for our securities and pushes the cost of capital down, right? Because there's more demand than there is supply, so prices go up, yields go down, and that's kind of what you're seeing here. It's had a big benefit to U.S. financial asset holders, and if you let me see if I can, and to sort of put the finest point on that, this is a chart. The top chart there is from the Fed, Federal Reserve. That is the growth in net worth in U.S. households over this 20, 30-year period of time. So again, as capital is coming into our capital markets, it's pushing prices up. It's pushing the cost of capital down. It's benefiting U.S. households in terms of their net worth over time. And so I just sort of make that point to say, if the view is that we should think about recalibrating global trade, particularly with our trade deficits, keep in mind there may be a countervailing impact, which is capital flow outside of the United States. And there's not a normative statement. Those are just sort of facts. They go hand in hand. It's a function of national income accounting. If we're not buying as much, then we're not borrowing as much. Our currency, if it weakens, then foreign currency becomes more attractive relative to the United States dollar. Things valued in those foreign currencies become more valuable relative to things valued in the United States dollar. So returns in ex-U.S. investments may have more value to returns than to U.S. securities. So this was not something that we had taken into account in 2023. Frankly, honestly, never saw this one coming. It was just something, but it was something that's been building for years as we sort of look at it. Before I go, the bottom chart there, which is the orange and blue lines and the lines there, that is U.S. and global GDP growth. And so what it's showing you is that over time, U.S. GDP growth has slowed pretty precipitously, but it's at the same time where U.S. net worth, household net worth, has gone up. So make all of that point to say that for all of the consternation about trade deficits, our capital markets have been pretty good beneficiaries of it. From my perspective, all I care about is sort of our mission to our retirement system beneficiaries is what does this mean for asset allocation. I don't know right now. It is something that we're looking at and something that I think we probably should consider as we reconsider asset allocation over the next couple of years. Who knows? Maybe it's too early. These things can go on for a long time. But it's something I wanted to leave you with in terms of the things that we may be considering in terms of asset allocation. So in sum, thank you all for having me today. It's been my honor. State Board of Administration, our mission is to provide financial security We do that by generating excellent returns, and we do that on the back of asset allocation. We made our asset allocation changes in 2023 because of a shrinking equity risk premium. We stand by that and think that's still the case. On a go-forward question, it's an open question around whether we do anything with respect to things that we're seeing in the current markets around national income accounting. So I hope that didn't go on too long. I guess this is the question and answer phase.
If anybody has any questions, if you'd please come up and say them into the microphone. Thank you.
Yeah, sure.
I got it. Before you get started. Hey, neighbor, how you doing? Quick question for you, Mark. Tell us a little bit about what certificate of participation COPs are and why you think they may represent a house of cards.
Well, I will. And so this is a little bit of a blast from the past. I'm sorry. The question was, what are if I can have a little bit of a trail off into the definition of certificates of participation, and why have I been in the past concerned about them? And so this is a little bit of a blast from the past. For those who may not know, years and years ago, I used to work for Ben Watkins, who is the director of Division of Bond Finance, and that was because I was a bond lawyer, and so one of the things that I got exposed to was how school districts finance themselves. And they had historically, at the time, financed themselves through the issuance of what's called certificates of participation. It's basically a lease arrangement where schools borrow money, build a school facility, lease the school facility, and then the lease payments pay for the debt service on the bonds. That's sort of the structure. But there was the way that was done. It was basically once you sort of move through all the hoops, you realize that essentially what they're doing is they're essentially pledging ad valorem tax dollars to pay debt service. In Florida, in order to do that, you got to have a referendum. But they were doing this without issuing a referendum, and it was a very popular thing to do. You could look at the amount of general revenue bonds that had been issued. Prior to these COPs coming on the scene, and you can see a pretty significant drop once COPs came on the scene. So it was displacing the normal modes of financing in a way that didn't require taxpayers to kind of have to view on it. So, being the good steward that I was, I wrote a law review article on it back 2012, I think it was. So it's well, we'll never hear anything about that, and so it has been kind of the case, but it's come up from time to time. Mark, I think, has pointed it out and trying to mention to folks that this is probably not the best thing to do. That if at any point in time the legal determination that you're not pledging ad valorem dollars to pay debt service changes, then you've got a lot of debt on your books that is questionable in terms of enforcement. I'm not making any prognostications about that whatsoever, at all. I'm just sort of giving you a summary of what the law review article said. But I think that's kind of the answer. Sorry.
Thank you. No, this has been fabulous. You talked about artificial intelligence. How are you seeing artificial intelligence come into your world?
Well, and this is something I think Chris Spencer could talk about. He's been pretty proactive in trying to kind of sort of assess it, and then implement it at the State Board of Administration where it makes a lot of sense. So we have our investment managers are certainly into delving into that, and I think from them. Their perspective, it represents a productivity enhancement there, where they might have needed, an army of analysts. They may now need a lot fewer analysts to sort of analyze and give you results on the same data sets. We have implemented it internally through Copilot and primarily. Looking at it, and have found, it's pretty impressive, and would anticipate seeing additional productivity gains over time. But it's something I think our culture is to kind of, we're not first movers. We kind of want to watch and see how other people adopt and learn from other people's mistakes rather than making them ourselves if we can. So it's sort of TBD. But we have definitely seen our partners really stepping into this, and they believe that there's going to be real productivity gains to it.
One of your earlier slides, you were showing on asset allocation. You showed real estate. Yeah. Are you all directly purchasing real estate, or are you doing REITs, trusts, and other syndications, or some combination?
It's a combination of both, but mainly direct owned. So we have about $20 billion of the portfolio in real estate. 2/3 of that is direct owned, where we buy or build we call it core, and the idea is that we want to either buy it or build it and lease it to high quality tenants. It's not a value add kind of approach, low leverage, good locations, and it generates a good cash yield for us over time. And so 2/3, I said, of that $20 billion is in direct own. The rest are in funds, by and large, investment funds, where we're able to invest in the slightly more higher returning, so value add, opportunistic, where we have fund managers who are pretty adept at doing that. And so that's kind of how we split it out. We also have a little bit of ex-US investments through those investment funds as well.
Hi, I'm Marshall Cassidy. Thanks for your presentation.
Sure.
What are the top 4 or 5 sectors of your equity portfolio, and where do you find you're moving more capital right now?
So it's a good question on the sectors. I'd have to pull up one of our slides, charts, to kind of see from a sector perspective, whether it's healthcare. We manage to the ACWI target, primarily. So it's a global target. And so it's going to be, about half of that, or 60% of that's going to be in the U.S. So it's a Russell 3 and a Russell 1 strategy there. It's going to be MSCI World for the other 35 or so percent of it, and some emerging market exposures. And to be honest with you, I can't off the top of my head recall sort of on a sector weighting basis how much is in healthcare, how much is in technology. Probably a lot of tech, though. I mean, a lot of public exposure.
Are you more
in tech.
defensive in nature right now with utilities or banks, or are you more out in the AI out in the growth area? We run our portfolios. We assign a benchmark, and then we try to stick to it. So there's a little bit of risk budget associated with it. Where we want to try to generate the alpha is through the managers that we hire in the active space. So it's security selection for those managers in areas where we think that there's security selection alpha, which is largely going to be outside the United States. And so that's kind of how we're looking at it, but not necessarily thinking about it in terms of defensiveness. Our view is the rest of our portfolio is there to help us be defensive where we need it to be. So the core fixed income exposures, which can have some correlation to equities, but a beta perspective, the beta is still relatively low. So you can still have good correlation, but the magnitude of that movement may not be good, very big. So we can have that diversification in our fixed income. Real estate is actually pretty diversifying. So that defensiveness kind of comes through how we look at the portfolio in total. How much do you manage internally?
So we manage about half of the assets internally, but I'm counting the direct owned real estate as part of that. So about 50% of our $100 or so billion public equity book is managed internal, and the vast majority of that is passive. We manage about 2/3 of the fixed income book internal, and a good chunk of that is actually active. That's a space in the fixed income markets we feel like you can get, you can do pretty well being an active investor in fixed income.
Okay. Thank you.
If you would please join me in thanking Lamar for his time.
You've been listening to Lamar Taylor, Chief Investment Officer for the Florida State Board of Administration, speaking before the Economic Club of Florida on June 26, 2025 in Tallahassee, Florida. For more information on the State Board of Administration, visit sbafla.com. The Economic Club of Florida promotes interest and enlightenment on important economic, political, and social issues of the day. To learn more, including how to become a member, visit our website at economic-club.com. This program was recorded at the Florida State University Alumni Center in Tallahassee, Florida.